and I'm thrilled to have Aubri Holler with me today to talk about the world of settlement. Aubri has done everything in the settlement world, the title world. She's had her own company. She's sold her title company. She's worked in it. She's currently Chief Operating Officer with Title Company of Jersey, and so she is an expert in the title world. And so we're going to ask Aubri some series of questions, but then I want you to go through the chat feature. This is your chance to actually ask a question to a settlement agent, and so you can understand all of that from their viewpoint. So, okay, let's open it up and let's talk to Aubri. Aubri, you there?
I am here. Can you hear me?
Yes, I can.
Okay, great.
You sound like you're right next door. So I'm thrilled to have you. And when I was thinking about who I was going to ask to talk about title and settlement and all that, you were the number one person. So I'm thrilled to have you. And I'm so excited that you're going to share kind of your view of closers. So we have all the closers in our class today. Many of them are new people. Some of them are starting to have a pipeline and actually closing. And so I wanted to start off with asking you, again, talk about what the title company does, the settlement company does, and also talk about, I mean, I'm sure you've closed millions of loans, not millions, but thousands of loans. Talk about that. So what's the title company's operation looks like, the settlement agent's operation look like?
Sure. So the settlement side on the settlement side of the closing prep is very similar to what the mortgage closers experience.
Right.
It's a collaborative effort between a mortgage closer and a title settlement officer or clerk or closer or title processor, because they have multiple names, to get that closing completed and to the table. And so, the settlement title processor will take or communicate and collaborate with the closer on the mortgage side in order to create the final CD. It's important for both parties to understand that the mortgage closer has certain obligations from a compliance standpoint, and the title company also has obligations to a compliance standard, and sometimes they're not the same. So, from a logistics perspective, the mortgage closer is going to provide the loan closing figures and all of the data that was provided in the initial contract. The title company then provides additional information that the mortgage closer is not really aware of and doesn't calculate on their own, such as tax adjustments, contractual agreements between the parties that are financial that might fall outside of the norm of a deposit or a concession or a seller credit. Adjustments on homeowners association dues and survey fees and title insurance fees. So between the two people, you're going to get one whole closing statement. After the closing statement is balanced between the mortgage closer and the title closer, the title closer then has to not only receive and print the closing documents from the mortgage lender, but also prepare their own title documents to go to the table that are required for the title insurance policy. So one of the struggles that I've seen over time, because I've been in this industry since 1997, and I've seen the evolution of emailed packages. I know that everyone is working on a deadline, but sometimes when email came about, it was like the title closer was getting the closing package 5 minutes before the closing was going to happen, and they had to do all of their work. So I think as a mortgage closer, when you talk about the effectiveness of the relationship with title in order to achieve the common goal, it's about collaboration and really understanding where each person's at in their timeline and what they need to do to accomplish what they need to accomplish.
So Audrey, maybe if you can clarify for our students about what title insurance covers, although we've covered that in a class, but maybe kind of summarize, what the title company is responsible for.
Sure. So the title company is responsible for ensuring that the owner, if it's a purchase, uh, has gotten free and clear title, which means that there are no external or outstanding interests in the property other than the buyer's current interest being conveyed at closing, and that there are no outstanding liens on the property. With respect to a title insurance product that's being issued for a lender, which is in both the case of a purchase or a refi, the title insurance company ensures that that lender's money, that lender's mortgage is first lien position on the property.
Right,
So in order to do that, we need to make sure that all of the liens on the property at the time of closing are paid and satisfied and or subordinated to the new lien if it's a refinance.
right, right. So when you look at, again, with all your experience and all since 1997, what type of problems happen at the closing that are really fairly significant?
Well, certain things can happen. From a loan perspective, fees can be wrong. That can't be changed unless it's redisclosed.
Right,
Um, I've seen the purchase price being wrong. So say on a new construction, this is a good example of it. So new construction, you have the purchase price, but then sometimes the buyer is also paying for upgrades, and those are rolled into the purchase price.
right.
The
Yeah,
lender has just the purchase price without the upgrades as the purchase price, which
right.
I've seen happen. The closing has been delayed because now the LTV is off, the loan
Sure.
amount is off, and we have to redisclose everything.
So when you look at, again, looking at it from your side, what would be the best practices of the lender preventing a lot of these issues happening?
Communication and extra due diligence in reading the documents and verification. So as much as it's counterintuitive to our world right now, slow down and really treat the title company as your partner. I've seen relationships between lenders and title companies that are contentious on both sides because we have these timelines, right? And we're pressured. And it's really important to keep open lines of communication and ask questions when something's unclear, because that's usually where these errors happen.
Right. And so from your viewpoint, how would you define what would be a good closer on the mortgage company side? What do you see as the practices that the good closers do?
So the good closers are responsive to stakeholders, right? They are um, available when there are issues at the closing. They are knowledgeable in title. So learning what the other parties need to know on the transaction is really going to make a good closer. Um, those are the three things that really stand out in my mind of all of the people that I've worked with. Those were the people that I had the most success with on loans.
Right.
It was smoother for the customer in the end because there was a lot of communication and respect for each other's priorities.
So with COVID in our new world, how has that impacted the closing? A lot of lenders are doing kind of remote online signatures. Talk about that.
So the remote online signatures is something that is still a little controversial as far as the closing. New Jersey had temporarily approved remote closings, but I believe that that's been reversed or at least backed off of. But there is a big push in the industry to start getting remote online notarization a regular practice in the real estate. It has not gotten there yet. So I know that lenders have made strides toward that with e-signing pre-closing documents, right? Applications and all of that. But as far as the closing goes, we're still doing wet signatures for the majority of the closings, at
So
least in New Jersey.
right. So talk about wet signatures and dry, the dry, because I think some people don't know the difference of that.
Sure. So a wet signature is literally that wet ink on paper.
Right,
So,
right, right.
right. So, when we talk about wet signatures, we're talking about documents that are critical that need to be signed originally. In my opinion, most of the closing documents at the closing should be able to be e-signed, but the mortgage will still have to be signed in person.
Hmm.
Even if we do a full, switch over to remote closings. And that's because the county clerks still require original signatures if you send the documents to the county clerk. So sometimes we're e-recording. Sometimes there are still cases where we have to send them to the county clerk, and therefore we need an original signature. Um, but original signature on the note and the mortgage are probably going to continue even if we move to remote closings. But I could see a world where the borrower gets their closing package the day before closing, e-signs all of the disclosures, the occupancy affidavit, the truth in lending statement, all of that stuff, and then goes to the closing, signs the note and the mortgage with an actual pen, and gets their keys.
Yeah, that's you're right about it. It's controversial for sure, but the trend is definitely that way. So what forms of when you are doing a closing, what forms of ID are typically required at the closing? And how long does the
Typically,
closing take? That's another thing.
well, that depends on how skilled you are.
Yeah, right. That's what I want you to talk about.
Right. So I would say that a closing should not take more than an hour.
Right.
There are some areas of the state where people get chatty and they don't really look at things prior to coming to the table, and they have lots of questions, and the closing can drag on for 2 or 3 hours.
Hmm.
In my practice, my closings take 30 to 60 minutes max.
Hmm.
And so the way that I've been able to achieve that is a lot of communication with the customer, giving them their closing documents the day before, reviewing the closing statement with them over the phone and answering their questions ahead of time.
Hmm.
And so really when they get to the closing, I used to say to them, it's a sign and drive time. They already have all their questions answered. Most of the disclosures they've seen before because they signed them when they applied for the loan. And so you're really going through and underscoring the important things that they need to know. So a closing, if you know what you're doing, should not take more than 60 minutes.
So what about the ID situation? I know we've had a lot of questions in the class. What
Yeah.
identification do you look for at the closing?
So typically a borrower will need two forms of ID. Definitely a driver's license or a state ID of some sort, a government issued ID. And then a secondary ID can be really anything. It could be a membership card or a health insurance card or a credit card. So just like when you go to the DMV, you have to give them your driver's license and a second form of ID, and usually you just pull out your debit card and that's your second form of ID. It's the same for a closing. If you look at the ID certificate that's in the closing packages, when you read the closing documents that you're producing as the lender, the instructions are right on the form as to what forms of ID are acceptable and looked for. Another one is a social security card, but I typically do not like to take that just because it's too sensitive. That information is way too sensitive, and we scan that and it gets transported and it's just, and you copy it and you can't redact that information because then voids the purpose of being an ID. So I don't like to ask people for their social security card, but it is one of the acceptable forms of ID.
So let's talk about problems, the famous problems at closing. So what are the types of things that you've seen, and have you seen deals actually fall apart at the closing?
Pat, I thought you said you wanted me to do this in 20 minutes.
Well,
So,
hit the highs.
yeah, okay. Okay, so let's talk about closing problems. To be honest with you, um, as time has gone on and the process and documentation processes have changed in the pre-closing phase, not many closings fall apart at the table anymore.
Yes.
Um, and that's absolutely true. I mean, let's just talk about the olden days, right? So the olden days where you got the closing package via FedEx and nobody really saw anything until the day of closing. And lenders had carte blanche ability, or loan officers had the carte blanche ability to change the fees at the last minute. I saw a lot of closings fall apart because I had customers come to the table and say, well, my loan officer said I was only paying 1% of the loan and there were 5 points being charged. That doesn't happen anymore. So from the aspect of the customer being surprised by fees, that's kind of taken itself out since TRID, right? So the only other option, the only other ways that a closing could really fall apart at the closing is if there are walkthrough issues, right? So we're talking about a purchase. If the customer walks through the property right before the closing to make sure that the property is in the same condition it was when they looked at it. And if there's significant damage to the property, they may not purchase the property.
Hmm.
Other issues could be that a title issue arises that the title company failed to notify the client on that changes their way of enjoying the property, ownership of the property, such as an easement that runs right through the backyard where they wanted to put their pool,
Hmm.
right?
Yes.
So really significant things can make closings fall apart, but it's pretty rare now that people get to the table and walk away. They're going to walk away prior to.
Good point. So talk about future trends, which you've already kind of mentioned. What do you see going on in the world of title and closings that you think is going to be a trend?
Oh, technology, technology, technology. So the mortgage world is just a little bit ahead of the curve as far as technology than title. Title is coming up quickly behind, but there are a lot of technological advances and investments being made in the title process. One being the remote online notarization, right? So we're talking about, remote closings, which I think is going to come to fruition within the next 5 years. But like I said, I still think there's going to be a meeting at the table. It just won't be an hour, it'll be 10 minutes.
Hmm.
Because I think people will still have, I mean, we still have to exchange the deed, right? We
Right.
still need to get the keys, we still need to give the money. So there's still going to be that closing, but I think it's going to be a quick meeting. It's not going to be a process because that process will be done remotely and prior to. Um, I think that, I'm working with a tech company right now that's developing artificial intelligence to create a title decisioning model that is going to enhance or replace the title examination piece, which will make the title commitment um, much more faster to get, right? So right now your title commitment is between 3 and 7 days on average, depending on what county you're in and what title company you're working with. This AI product could automate 80% of the examination, reducing that time to 24 to 48 hours turn time from order the
Mm.
search to getting a commitment. So that's going to shorten your closing time, right? So all of these companies, fintech, real estate tech, title underwriters are all looking at ways to consolidate the process and make it simpler for customers. So to the extent that we can use technology to do that and present the customer with one singular view of their transaction, that is really where the industry is going.
Well, that's interesting. Well, I'm not surprising because I think the whole process is getting changed. I think COVID had a positive impact where it's forcing a lot of issues to get addressed that companies knew and lenders knew, but now it seems like they're definitely moving in that direction. I have one last question to ask you. You also are a real estate agent, and I want to have kind of your view of the closing so that the students understand from how a real estate agent looks at the closing and what they consider a smooth closing.
They get paid. No.
Yeah.
So,
Well,
okay, so it's interesting that you asked me that because I'm a little pickier than most because I know what's behind the curtain. But I would tell you that from a real estate perspective, real estate agents are very concerned about the experience that their customer has. So it's not really about the real estate agent's experience with the service providers or the stakeholders involved, such as the lender and the title company. It's more about how collaborative those partners are with the real estate agent to support the customer, because real estate agents depend on referrals. So if their customer, if I give a customer to a lender and the lender botches the loan, or my customer has a horrible experience, from that customer's point of view, I referred that lender, I'm the one at fault for their bad experience. So I think the key to the real estate agent being happy with partners that they work with is to really keep the customer at the front and center through the whole process and make sure that the agent's able to stay in the loop, right? So if I'm in the dark about my transaction and my lender's not communicating with me and my title company's not communicating with me, then I can be caught blindsided by a problem my customer's having and not have an explanation, and that makes me look bad. So really it's about that. It's about including the real estate agent and supporting the customer